Hello, I'm Gwen Reed, and I'm going to discuss the treatment of SCorp shareholders that have a home office. I deal with this every day, and I found that many accountants, CPAs, EAs deal with this in numerous different ways, and every way seems to be pretty different. In my research, I've found that there's three separate ways that the situation's been handled. As a rental on a Schedule E, as unreimbursed employee business expense on Schedule A, subject to the 2% floor, and through an accountability plan. The first area of topic that I really want to discuss is Section 280A, which deals with the home office. This is where the company reimburses the employee's business expenses, percentage of utilities, maintenance, etc. Section 280A in the general rule is when a taxpayer who's an individual or an S corp is not allowed to deduct for certain expenses in connection with the business use of a dwelling unit which is used by the taxpayer during the taxable year as a residence. However, much like any other parts of the code, there is a caveat for this. It contains a limited and explicit exceptions to the rules for deduction to be allowed under 280A C1. A taxpayer who is an employee must establish that a portion of his dwelling unit is 1, for exclusivity use, 2, on a regular basis, for the purpose described in 280A C1A, and the taxpayer maintain the office for the convenience of his employer. In addition to this, the deductions that are allowed may not exceed the gross income derived from this. So what this means in basic terms is that the deductions cannot exceed income no matter what the amount of usage is. When I was explaining the exceptions, I noted that Section 280A C1A, and what this is basically saying is that the portion of the dwelling, being it a house, a barn, an office, has to be the principal place of business for the trade or business of the taxpayer. The principal place of the business includes the place of business which is used by the taxpayer for the administrative or management activities of a trade or business if there's no other fixed location for the taxpayer to conduct that business. This section not only pertains to the home office, but also for storage and daycare use as well. As far as the storage is concerned, as long as the space allocated is used on a regular basis as a storage unit for the inventory, for the taxpayer, for the personal trade or business of selling the product, either retail or wholesale, then the general rule does not apply. Remember that this is only applicable if the dwelling unit is the sole fixed location for the trade or business. As far as the daycares are concerned, and the code section, it not only encompasses children, but the elderly and physically and mentally disabled as well. However, there are some licensing restrictions to that as well. They have to show that they have applied for license, it's been granted, or there is exemption for having that license. If a portion of the dwelling is used for the caretaking purposes, but not exclusively for it, then there's allocation formulas that's used to determine the deductibility of the expenses. Now that we've kind of covered the code section related to this, let's go ahead and discuss the three different methods. The first method that I've seen come into situation is the rental to employer. Basically what has gone on is the SCorp rents the office from the employee who normally tends to be the majority shareholder. The corporation takes the deduction for the rent, and then the taxpayer picks up the income on the Schedule E and deducts expenses against it. However, the downside of this method is that your expenses are limited. You can only deduct the pro rata share of real estate, mortgage interest, and casualty losses against that rental income. These are the expenses that are normally deductible on Schedule A. No other expenses, insurance, utilities, depreciation are deductible, and this is actually highlighted under Section 280A6. The reason that this section addresses this issue is to make sure that there isn't an inappropriate conversion of non-deductible personal expenses into deductible living expenses, and also to permit the deduction of legitimate actual business expenses that are incurred in the home to produce the income. Now, the next method I kind of want to talk about is the unreimbursed employee business expenses on Schedule A that's subject to the 2% on Form 2106. I've seen this happen numerous times as well, Taxpayers who are not clear with the code have been given this advice, and this is kind of where they go. So what they do is they fill out a Form 2106 for the business expenses home office, and this is where they can take the depreciation and the other expenses that were not allowed in the rental on the Schedule E. Um, the preparers and taxpayers can actually look to publication 587 for more detailed description of the rules and what is deductible versus non-deductible as far as business expenses. The recommended method actually for the home office that not a lot of people, not a lot of shareholders and SCorp clients are aware of is the accountability plan. And what exactly does the accountability plan mean? It's kind of hidden in the code, so it was kind of difficult to find. But basically what it is a contract that's set up between the SCorp and the shareholder for reimbursement of expenses. The best part about this method is that the corporation picks up all the expenses, therefore it's decreasing their net income, and the taxpayer doesn't have to report the payment as income on their tax return. This should realistically be put into a contract or some other written documentation between the S-Corp and the shareholder for actual job expenses that are supported by receipts or other documentation such as an expense report. Remember that if you use this method, any item that you're reimbursed for, such as any Schedule A items, mortgage interest, real estate, that needs to be reduced on your Schedule A. So say, for instance, if you had $15,000 in mortgage interest during the year and the S-Corp reimburses 10%, then your deduction on your Schedule A should only be $13,500. So that's kind of the overview of how it is. So let's kind of look at a little example of how this would come into play. So let's assume Tom is a 100% shareholder of Mountain Corporation. Tom writes a contract with Mountain and states that Mountain should reimburse him for 10% of the expenses related to his home office use. We're assuming that in this example, it's 10% of Tom's house is used strictly for business purposes and meets all the requirements under Code Section 280A. At the end of the year or month, whichever Tom decides, Tom submits an expense report for 10% of his interest, property taxes, and utilities, and the S-Corp reimburses him and takes a deduction for it on their return. Tom doesn't have to pick up any of this reimbursement on his personal tax return. It's fairly simple and easy and a great way for shareholders to maximize their deductions. One major note that seems to get overlooked on a home office is depreciation. Preparers and taxpayers should be aware that any post-May 6, 1997 depreciation has to be recaptured if the house is sold. I've run into this situation a few times, and clients are not happy that they're informed that they have to recapture that depreciation and pay capital gains and the tax on that. So that's definitely something to look at whenever you start taking the home office. The home office deduction is a great way to actually decrease your net income if you know the proper rules. So my name is Gwen Reed, and that is my presentation on home office deduction for S-Corp shareholders.